Not a lot of dry powder left to save other folks that might be feeling more pain. And again, other companies that might go down. The fact that BlockFi has also said that it would be pausing withdrawals has a lot of people equally worried as what is happening to FTX, because you're going to have more customers feeling pain. And again, a lot of these are brokerages and retail investors, so they may never be made whole.
Sonali, stay close. I'm just going to work through the opening band. I'm going to come back to you in just a moment. About 2 minutes and 30 seconds into this on the S&P, positive about 0.1%. Pretty muted price action relative to yesterday, of course. Energy rallying back by 1.6%. Healthcare negative 0.6. Staples down 0.4. Utilities down 0.4%. Abby, elsewhere, there are some big moves out there.
There are certainly some big moves related to that FTX bankruptcy headline, that announcement, and what is happening there. And of course, it has to do with the crypto space. We have many crypto stocks at this point plunging. And if you recall yesterday, going along with the risk on mood, we had a big rally after days and days of brutal action. In fact, a year of brutal action. But you can see today, Marathon Digital down nearly 10%, Coinbase down 6%, MicroStrategy, Riot, Blockchain also down about equal amounts. And of course, these stocks are also down sharply over the year. Coinbase in its short lifetime is down 85%. So some of this uncertainty around the crypto space and the possibility of what we're seeing relative to this liquidity crunch, the fallout of FTX, not so surprising. But the big question that you and Sonali were just talking about, and everybody's been talking about for a few days, what does it mean for the broader equity markets? The S&P 500 E-mini futures earlier today had been up 0.9%, taking a leg lower on these headlines. And also over the course of this year, we have crypto and the S&P 500 trading in lockstep. If we go into the Bloomberg terminal, we can see that. The big question is the recent plunge that we see there in Bitcoin, and Bitcoin, by the way, taking a big leg lower on these headlines, right now down 7%, earlier down just about 3%, and frankly, earlier it had been higher. But you can see that divergence right there, John, between the S&P 500 going higher, Bitcoin going lower. Can these two risk assets go in that direction, especially as we try to figure out how far and wide this liquidity crunch stretches?
Hey, Abby, thank you. Great work as always. Sonali, just a final word from you, please.
One other company that I'm watching, frankly, is Skybridge, because they're just one investor out of many that have been making this crypto pivot. They bought at an average price of 18,000. You have crypto, Bitcoin now down to 16,000. Imagine just how many investors, John, large investors, are in the red today.
Painful stuff. Sonali Basak, Sonali, thank you. Sonali's going to run you through the story all day on Bloomberg TV and radio. We get lucky this morning. Morgan Stanley's Mike Wilson in the last week came on this program and said, stay bullish. That paid off in a big way. Mike Wilson joins us right now. Mike, can we just start with this mess playing out in crypto all around us with things like FTX? What does it mean to you, Mike, looking at the broader equity market?
Yeah, I mean, look, this is financial contagion risk. I think part of the reason we rallied so much yesterday, quite frankly, is because I think there was people putting crash protection on into what was, an event that had been obviously previewed for several weeks. I mean, the CPI release was the event. It was actually the fourth event in 2 weeks that we've been focused on, that we've been kind of waiting for to finally get this rally in bonds, John, that we've been talking about, it seems like, for months. And, the four events were the Fed itself last week, which, remained hawkish, but, kind of opened the door to a step down in terms of pace of rate hikes. And then, of course, we had the strong non-farm payroll number. Then we had the election, which I think will lead to a mixed government at the congressional level. Maybe not a red wave, but enough to block, crazy fiscal next year. And then we got the CPI, which really confirmed a view we've had for a while, as you know, which is that inflation has peaked, and it's probably going to come down pretty quickly. So all that leads up to what we think was the fattest pitch in the market, which was going long duration. And that will lead to the next leg of the equity rally, because as rates come down, what I think will happen is, we saw this yesterday, so it's good confirmation, the NASDAQ, which has been the laggard in this rally so far, can now catch up. And that's what happened yesterday. I mean, obviously the whole market was up. It was led by, these longer duration growth assets, and that's tied directly to the move in rates. So that's basically our call to a T. The tricky part now is going to figure out, okay, when is it over? I don't think it's over yet. I mean, clearly this overhang from crypto is not constructive, but I think what it did yesterday, I mean, we saw a big retail selling yesterday. So it's amazing to me is that we're having this event, which is a little bit scary, and yet the market was up, 6, 7, 8%, depending on which one you're looking at, which tells me that people were just out of position. So probably further to go, I would say, through Thanksgiving, maybe even into early December. you know us, John, we'll manage this tightly. We'll be disciplined, but I don't think the rally's over at this point.
Mike, have you had a rethink of the range, the initial range that you introduced for this bear market rally?
Yeah, so 4,000 to 4,150 was the range we targeted on the S&P 500. As I mentioned earlier, the Dow Jones and the small cap index actually already exceeded its 200-day moving average pretty substantially in the case of the Dow. So as the Nasdaq maybe gets towards its 200-day, we could actually see the S&P maybe go through its 200-day to the upside. I mean, I don't know. I mean, it's hard to be that precise because we do think this ultimately is a bear market rally. But once we get through the 200-day, that'll probably get the animal spirits going even more. That'll draw in more, kind of passive flows that track that type of data. And we could see an overshoot, I mean, I wouldn't rule it out. Something like 4,200, 4,300. We'll just have to wait and see how it goes, John. It's going to remain volatile. This is not the kind of market that the average person should be trying to trade. This is a trading call. It could be very profitable if you count it right. But it's still a bear market, so it can rip you apart.
Mike, what is it about Q1 earnings, or rather Q4 earnings that you'll see in Q1, that you think ultimately make this a bear market rally and nothing else?
Yeah, so it's just finishing the original thesis, John. As you know, the fire and ice is just not complete, right? We've had clearly way too much fire with inflation. The Fed has reacted to that. That's really what the bear market's been about so far. I would argue that the crypto collapse is directly the result of tighter financial conditions, and that began over 18 months ago, so this is not new news. What is new news, or I think what's going to be new news, is how significant the negative operating leverage is going to be next year for a lot of companies. We've got a sampling of that with the big tech companies, obviously, in this last earnings season, and I think it's going to be quite broad. So, as we've said on this program a million times in the last couple of months, we ultimately think the earnings forecasts for next year are substantially too high, and we think that process of readjusting those estimates will begin in the fourth quarter reporting season, because that's when companies will have to address 2023 forecasts, which they haven't done yet. And that's the catalyst. There could be other catalysts as well, but that's the main one. It's basically the slowdown that will hit earnings significantly next year, even in the event that we avoid a recession, which we think is getting less likely. But if we do avoid a recession, that means less employment cuts, which means even worse operating leverage. So that ultimately has to play through. Does that mean new lows are guaranteed? No. But I would say a retest of the 3,500 level is probably pretty much in the cards, and then we ultimately think that will get taken out.
Can we talk about the cost cuts we're seeing in tech at the moment already, the tech austerity? Amazon reported by the Journal yesterday that they're going through a cost-cutting drive. And this was a number that jumped out to me just on the amount of jobs growth we've seen in that name. Between the end of 2019 and the end of 21, Amazon hired more than 800,000 employees. Just how much excess do we need to work through here, Mike? You've been thinking about this for a long time. How much excess is there that we need to cut?
Yeah, and like everybody, I mean, we get caught in our own narrative sometimes, and so we've been looking at this. We've been waiting for this for 9 or 12 months, as you know. I mean, this is part of our thesis, and so then when it starts happening, we start to question, okay, well, is it priced? And I would say I don't think so. In other words, I think this is the first of many cuts that we're going to see, not only for these companies, okay, but companies writ large. We've seen over hiring, over inventorying, over ordering, and that all has to get wrung out of the system. Some companies will navigate that quite well. That's why we've been focused on this factor of operational efficiency so much all year, John. We think that will continue to carry the day, meaning own companies that didn't over hire, didn't over order inventory, et cetera, and then they can manage through this. I think that, look, this is another reason why NASDAQ can have a big catch-up move, though. These companies are starting to take action, right, finally. And that's a positive. I mean, as we've said to you on this program before, I mean, one of the things we'll look for, for the end of the bear market is when we actually do get an employment cycle, right? Because then the bleeding will stop on the margins front. But we haven't seen that yet, broadly across the economy.
A bit softer this morning, 11 minutes into the session, we're down 0.2%. On the Nasdaq, we're down 0.1%. I want to break down that breaking news of the last 15 minutes or so. FTX commencing Chapter 11 bankruptcy. We've talked about the risk of contagion from crypto, perhaps into traditional asset classes. Peter Schiff of Academy joined us on this program yesterday. Take a listen to what he had to say.
What does this do for the economy slightly longer term? You're going to see less spending on semiconductor chips, right? They were huge buyers for these mining rigs for all the software that they needed. You're going to see less ad spending, right? We might finally be able to get through a sporting event without Matt Damon telling us to, march off to do something exciting. And finally, I think we're going to see less energy use as mining drops. So there's going to be a lot of real-world repercussions from this.
Mike, I'd love to give you a final word on this. What you'll be telling clients today about what's developing in crypto and what it means for them.
Yeah, I think that guest comments were right on. It's part of the kind of binge spending on a bunch of things that we saw. I mean, we've talked about this for semiconductors for a while, that you had a pull forward on a lot of different areas, and crypto mining was one of those. Okay, and that's ultimately going to have to reset. And like, I don't think the semiconductor cycle has bottomed as a result of that. Our analysts feel the same way. There's going to be more bad news. It's not just crypto. Okay, it's also we overconsume PCs and handsets and all this electronic stuff. But ultimately, it will lead to a new cycle. Okay, what I want people to focus on now is this bear market is not new, right? I mean, this has been going on for 18 months. And I think, some people have just kind of figured it out maybe in the last 3 or 4 months. And so we're now in the mindset. We want to be more balanced in our thinking. We've been very bearish for 12 months, and we're just starting to, be more balanced here. That's why we made this trading call. And what investors should be doing now is finding companies, finding investments across the entire capital structure that they want to own for the next 2 years. One of the areas has been in rates. We think bond prices got to a really attractive level, both, at the Treasury level as well as at the investment grade level. That's an area you can put real money to work today, and then picking a few stocks here and there as they kind of come to your price targets. We're in the final phase. It's going to be volatile. It's going to be really hard to trade. Okay, we don't advise people try and trade it. We're trying to trade it because that's our job. Right, but we're ultimately going to be making the final low, where the big fat pitch we think is probably within 3 or 4 months, but not everything will bottom on the same day. It's every investor's job to kind of find the price that makes sense at the stock level or at the security level when it comes to them.
Mike Wilson, wonderful as always. Mike's words this morning: it is still likely a bear market rally that can rip you apart. Mike, we appreciate your time this morning, sir. Thank you. About 14 minutes into the session, we're down 0.25%. Sonali, you've been breaking this story down. It's still developing. What do you see?
Just something that Mike Wilson said that I think is important that you have to consider here, John, is that the crypto crash here was a direct result of tighter financial conditions. And I just took a quick look on our bankruptcy page here, and it's true. You do see a lot of people having hired restructuring advisors, but that window of companies is widening. Even Elon Musk just yesterday saying that Twitter bankruptcy is possible if there's a cash burn that lingers, and the banks, including Mike Wilson's own bank, are trying to sell this debt at discounts as low as 60 cents on the dollar. That's the steepest discount in a decade. So if you're looking for money in a troubled market, where are you going to find it? It's going to cost you at the end of the day, and that's the fear that I think Wilson is hitting on. And frankly, the FTX story, the bankruptcy is just the beginning of the rest of the pain we may feel.
Let's keep talking about it. For sure, in the bond market right now, it's a buyer's market in a way that it hasn't been in a long, long time. If you're just tuning in, good morning to you. About 15 minutes into the session, equities down about 0.1%. Coming up, we'll catch up with Emily Rowland of John Hancock on this crypto mess and what it means for you at home. From New York, this is Bloomberg.
don't have the exact number, but I think at least we are talking about billions here. Right now, I think the most important thing is still we need to do a full due diligence to have a full picture of like what's going on, like how serious is the liquidity crunch.
Breaking news in the last 30 minutes. FTX Group says it's commenced bankruptcy proceedings in the United States. The group says that Sam Bankman-Fried has resigned as CEO. John Hancock's Emily Rowland weighing in on the long-term impacts of FTX's blow-up, saying the following: we are likely seeing a game-changer week in the cryptocurrency markets. Institutional interest will likely never be the same. We see massive write-downs still to come across the industry. Emily joins us right now. Emily, let's build on that. What do you make of this mess this morning?
Yeah, John, I mean, the thought about liquidity and the speed at which these exchanges process trading is really, under review right now. And I think the fact that these exchanges are not allowing withdrawals or distributions is going to put a major, major dent in investor trust. There's really no backing for these exchanges. We're probably going to see more write-downs here. It's a really, really challenging backdrop. And I think for a lot of us, a reminder of how important due diligence is. That can often be forgotten during bull markets, and it can help minimize losses. It can help investors allocate capital properly. And I think when we look back on this cycle, unfortunately, this is going to be a hallmark of this long-lasting legacy of the misallocation of capital.
Emily, is it too simplistic just to say that this mess is just about higher interest rates exposing the lack of discipline across one industry?
I think that's certainly a huge part of this story. I mean, the massive amount of stimulus that fueled this incredible amount of risk-taking is certainly part of it here. So we want to think about that. And as we look forward, we're continuing to see this wave of liquidity, this tide of liquidity going out, and it feels almost like a game of musical chairs, where we're going to be left to see, which players are over-levered, which players have we not conducted the due diligence on, and that's one reason we want to continue to find opportunities in higher quality parts of the market that don't have these issues, haven't taken on excessive leverage, and have plenty of cash to make it through this decelerating growth backdrop.
Mike Wilson of Morgan Stanley was on 10 minutes ago. He said this is still likely a bear market rally that can rip you apart. Bob Michael of JP Morgan Asset Management was on in the past week, and he said he thinks this might be the calm before the storm. Emily, what's your sense of that? Is this the calm before the storm?
Yeah, I loved hearing Mike say that, and I think it is. The market reaction to the CPI report yesterday was just a massive wave of short covering, and, it wasn't entirely unexpected to see inflationary pressures moderate. We've been expecting that. And by the way, if you thought yesterday's CPI report was soft, just wait until the housing market starts to catch up. We looked at the shelter component of the report yesterday, responsible for nearly half of the month-over-month gains. With mortgage rates now around 7%, we're absolutely going to be seeing a precipitous decline in home prices from here, and inflation is going to fall further. You also look at the comps. They were much higher last year. Last year at this time was really when that wave of inflation started to come through. So, inflation is going to fall. But what I think investors are missing here is that CPI always declines into a recession because demand is slowing. And John, markets are simply not priced for that scenario right now.
That's the next problem we've got to get our teeth into. Emily, I'm going to give you the final question of the week on this program. What do you use this strength for then, if you are this bearish still?
John, the holidays are coming up. What I would suggest you buy your friends and family are bonds. We look at the income on high-quality bonds right now, 5-6%. You're getting over what you've gotten in the last 10 years. We haven't seen yields like this. We like the income. We're taking it all day long. The leading indicators are negative for 3 consecutive months. The yield curve is the most inverted since 1981, telling us something is wrong with Fed policy here. We expect to see a big earnings decline. A normal earnings recession is about 20% plus going into a recession. We haven't even started to see that yet. So look to the income on higher quality bonds as the best holiday gift you could give your friends and family.
I'm not sure my mum wants T-bills for Christmas, but I'll give it a go. Emily, love it. As always, thank you. Emily Rowland there of John Hancock. Let's get you to the trading diary. That's coming up next. What a week it's been. Live from New York, this is Bloomberg. 25 minutes into the session. We're almost there to close out of the week. Equities unchanged now on the S&P, on the Nasdaq, basically unchanged as well. As some of the price action muted, of course, relative to yesterday. Let's get you to the trading diary. Tons to watch into the weekend. New Mitch, sentiment survey, top of the hour. President Biden speaking from Egypt at 10:15 Eastern time. Then heading to Cambodia over the weekend for a summit with leaders of Southeast Asian countries. Chinese President Xi Jinping and Biden meeting face-to-face in Indonesia ahead of the G20 on Monday. Fed speak picks back up. Waller, Brainerd, Williams all next week, and then US PPIs on Tuesday, and a ton of G20 stuff as well. Looking forward to that, looking forward to covering it with you. Almost at the weekend. Deep breath. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Friday, November 11th. Here are the top market stories that we're following for you at this hour. FTX contagion spreads. Sam Bankman-Fried resigns as FTX CEO. The company starts bankruptcy proceedings in the U.S. We're going to speak to the co-founder of the world's most traded cryptocurrency, William Quigley of Tether. And an ugly winter for Europe is coming. The European Commission slashes its growth estimates for next year, with Germany hit hard, inflation still around 6%. We're going to speak with the EU's Paolo Gentiloni. And a addicted to euphoria? Stocks pretty mixed as investors tried to build on Thursday's monster rally, helped in part by FOMO and China easing some of its COVID policies. Just how long can this trip last? From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Maybe we get one answer through the UMISH, which just dropped right now, Guy.
It has. I'm not sure this is particularly good data. It is good data, but it is not good from a market point of view. The headline number, 54.7, that's down from 59.9. That is a big drop for consumer sentiment. Current conditions still sticky. A little bit, well, actually, no, not so much, actually. 57.8 down from 65.6. That is below expectations as well. Looking out on the expectations number, 52.7 down from 56.2. And then, Alex, we get to the inflation numbers.
Yeah, but for the first time, it feels like the sentiment and expectations are a little bit more juicy than the inflation numbers because the inflation numbers didn't really go anywhere. The one-year inflation number stayed sticky at around 5.1%.
But that's the problem. The hope would be that these numbers would drop. If they're staying sticky, that maybe slightly undermines the case that inflation is starting to come down, which slightly undermines the rally maybe from yesterday. If this is sticky and sticks around at these high levels and it starts to get embedded, that's what the Fed might have a problem.
Or it has not fully accounted for the CPI that came out yesterday. So this wouldn't be reflected in the survey, so maybe sentiment is looking at the inflation numbers from weeks ago, which is maybe why we have to look to maybe what we're going to see in December to see any kind of real impact from it. I don't know. Let's ask the expert, shall we? I just want to point out that the 5 to 10-year inflation forecast estimate did come in at 3%. So that did increase just a touch, Guy.
Yeah. Which is what I think is going to be, that's going to be the issue with these numbers. Because if these numbers remain kind of above target for a long period of time, that's what the Fed is going to be, that's what the Fed's going to be focusing on. Let's break it down, as you say. The person you want to ask about all of this is Joanne Shu. She's director of the University of Michigan Surveys of Consumers. She joins us now on the line. Joanne, we've given our opinion. I think yours probably matters a little bit more. Talk us through these numbers.
So what we have seen is a decline in consumer sentiment over the last month, which shows that the tentative improvement that we saw from the historic low in June is indeed tentative. I think we're in for a bumpy road ahead. As you saw, inflation expectations have ticked up a little bit in spite of the favorable CPI reading we got yesterday. I think consumers aren't really going to fold in that kind of information into their expectations until this easing of inflation becomes more sustained.
What is behind the decline in sentiment, current conditions, expectations, the whole thing? What are the biggest problems?
The biggest issues that are on consumers' minds are, of course, continued inflation, but that's not new. What's a little bit new in recent weeks is that consumers are increasingly concerned about interest rates. They are telling us in terms of the current conditions, in terms of buying conditions for durables, they're really concerned about high interest rates making it a bad time to buy durables. And we're seeing that with respect to houses and cars as well. High-income consumers who have shown some pretty large decreases in sentiment over the last few readings are also being really influenced by turbulence in financial markets.
Interesting.
Fold employment into this, because employment is holding up. Why is the confidence number coming down when employment is holding up?
So labor markets are, of course, very, very strong right now. But at the same time, consumers are actually expecting some weakening of labor markets in the year ahead. We have the largest share of consumers expecting unemployment to increase over the next 12 months. And so we're seeing some early signs of weakness in the labor market, or at least consumers' views of labor markets.
Joanne, we also came off a week of midterms, and so I'm interested as to how the midterms affected this, and then how coming into a much more gridlock Congress than we may have been expecting, that may change or shift.
So the vast majority of the interviews we completed for November were completed prior to the election. So we're not really going to see an impact of election results until the end of the month. But that being said, there's been a tremendous amount of concern and anxiety and feelings around the around the election. A lot of consumers are spontaneously mentioning political factors at the end of our survey. So certainly that's weighing on consumers, but it's too early to tell how they feel about the results.
What normally happens at this point? Once the data starts rolling over like this, What happens next? What does history tell us, Joanne?
That's a great question. I mean, we're kind of in an unprecedented situation right now where we have this tremendous political polarization as well as this high inflation and, you know, kind of coming off of the pandemic. We have a lot of things that are weighing on consumers and weighing on kind of their attitudes overall. I think, you know, it's possible we could be at an inflection point, but it's we really have to see if these trends are going to be sustained. You know, I think, you know, I said a few weeks ago, and I think it's still the case, we're in for a bumpy ride ahead as consumers fold in all this information and some of the uncertainty hopefully unwinds, and if it continues, I'd expect continued bumpiness.
Joanne, this might be an unfair question, but you mentioned sort of market conditions also and what's happened in the equity market. Does what happened to the crypto market in the last 72 hours, do you expect that to affect this next reading of the survey?
My expectation would be probably not unless consumers are paying really close attention to it. Where consumers are being influenced by financial markets, it's very much a wealth effect on you know, feelings of their own assets declining and affecting their personal finances. And so I think with respect to crypto markets, there isn't enough, I think, broad-based penetration of that among consumers for it to really drive sentiment, but it could affect some consumers, certainly.
Joanne, the Federal Reserve pays attention to your numbers. How should the Fed respond to these numbers, do you think?
I think that the Fed should what the Fed should take away from our numbers is that consumers don't think we're out of the woods yet. And even though current CPI readings are looking like we've turned a corner, consumers aren't necessarily folding that into their expectations yet. At the same time, consumers are not really showing strong signs of inflationary psychology or entrenched expectations. Very few consumers believe it's a good idea to front load their purchases now of durables or other things in order to avoid price increases or interest rate increases for that matter in the future. So that's certainly a good sign, but we're certainly not out of the woods yet.
Yeah, no, definitely that's a good sign. All right, Joanne, thanks a lot. We really appreciate it. Wonderful incident analysis. Joanne Shu, University of Michigan Surveys of Consumers Director. Thank you so very much. All right, coming up, we're looking at the markets here. The S&P is now flat, kind of getting back to flat after the UMich numbers. But yesterday was a huge day. We broke through some key levels. We are, you know, reaching towards that 200-day moving average. So what do you do from a technical perspective? John Kolovos, Macro Risk Advisors, Chief Technical Strategist, will be joining us. He's called yesterday's rally breathtaking and one for the record books. We're going to get his read on the markets next. This is Bloomberg.
earnings season is here.
The earnings are starting to pour
The
in.
numbers are holding up better than expected.
Sorry, business isn't all that bad.
Bloomberg breaks the numbers first.
Netflix earnings going across the wire.
Big beat. Stock is up more than 8%, coming in stronger than their rivals.
With exclusive expert analysis.
Finally back to growth.
The mother of all opportunities.
What is the industry to watch? That's where the rubber hits the road for Goldman Sachs.
It's going to be a really interesting earnings season.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
So we continue to watch the impact of yesterday's inflation report on markets. Yesterday was epic. You don't often see days like yesterday. Today, a little quieter. Obviously, the bond markets out being a factor. John Kovalos, Macro Risk Advisors Chief Technical Analyst, joining us now. Wondering if this could be a crucial inflection point, I read here. John, can I trust yesterday's rally?
You can, and thank you for having me on. Can you trust yesterday's rally? I think you can to a certain extent, at least into year end, if not into January. What was quite interesting to me yesterday was not just the 5% gain. Yes, they tend to happen in bear markets, big moves like that. It really was the market internals that really caught my eye yesterday, and also the decline in the U.S. dollar.
And what caught your eye about it? What did you learn from that movement, price action?
Oh, so with the U.S. dollar, if you remember back at the end of August, I came on. I was like, I think the dollar is going to be peaking here around 114 on the DXY, and now it's happening. And it's a longer-term view, thinking like, if the dollar can peak here, it could go lower for about a year or so's time. And what would that mean for risk assets? It would be very favorable for risk assets. And now what happened yesterday, and this was a massive decline in the dollar, major breakdown through support levels, which increased the odds for the DXY to get down to 100. So a very important chart. You got to keep your eye on it. It captures everything macro right now, and that's really all that matters.
Okay, so let's extrapolate that move into the other asset classes.
Sure.
Talk to me about the S&P. Talk to me about the levels, the ranges we're now in. What is the trajectory?
Right. So when it comes to the S&P 500, first and foremost, I said earlier, I think the S&P is in a short-term tactical rally, uptrend, whatever you want to call it, into year-end. 4,100 to 4,150 would be where I would expect the market to go to and perhaps peak out. I think optimistically the market's in a range here, basing trying to form a bottom, but there's going to be a lot of digestion going on. But really, the internals is what really gets me interested here. Yesterday, 53% of the S&P 500 went above its 200-day moving average. If you use that as a general proxy of what an uptrend is, most stocks are in an uptrend right now, even though the index itself is not. So oftentimes, internals lead the market higher. But also, I think the S&P 500 is a terrible benchmark. It's a bit of a liar. It's too disproportionate to mega caps. And a lot of clients are just so despondent about it. And I'm trying to push them to say, hey, look, there are opportunities beneath the surface. And that's really captures my eye. Really, it's the internals. The market of stocks is better than the market itself.
Yeah, let's get to that, because if we talk about sort of what's priced in, is this a time where you want to be back into growth? Is it a small cap story? Like, where do you think those opportunities still exist over the next few months now, based on the price action?
Right. So there are times to buy good charts, and there are times to be buying bad charts. You need to know what regime you're in, what trend following regime you're in. And being a charter market technician, I tend to lean on trend a lot. But sometimes you just got to ignore it, or just kind of fight it a little bit, or embrace it a little less. And I think we're in that zone where that could happen, where a momentum factor crash could occur. Now, momentum factor crash occur when markets are bottoming, right? Because what is a momentum winner during a bear market? It's your defensives, right? It's your staples, it's your healthcares, right? And currently that would be energy. But what's on the other end of the spectrum? It would be tech, it would be parts of growth, right? Real estate, discretionary. So if the markets are going to bottom, then this momentum crash could very well occur, and you want to start buying bad charts. But the key part about it, and I put this chart in our deck for today, which is it's really dependent upon the macro. So the momentum factor correlates with triple B spreads. So if I'm right about the dollar rolling over and macro conditions are going to get better, then credit spreads should get better, and then we should start looking at not so good charts at that point.
John, I have to ask, one of the stories over the last 24 hours has clearly been what's been happening in crypto.
Yeah.
You got a view on what the charts look like? What does Bitcoin look like to you right now?
Yeah, I don't know if you want to hear it. The chart suggests that Bitcoin could get down to about 12,000. It's been my call for a while now. A major top formation occurred. It was completed in June. We can get rallies, of course, maybe to 20,000, but really the chart implies a move significantly lower, somewhere around 12,000 or so.
All right, John, really appreciate it. Thanks so much, John Kolovos, Macro Risk Advisors, Chief Technical Strategist. Good to see you. Good day for you on this, too. All right, still ahead, more in the market move here. We're going to talk with the head of America's iShares Investment Strategy over at BlackRock. Gargi Chaudhry joins us. This is Bloomberg.
Yesterday was a historic day. I think there's no question about it.
I think a lot of it just has to do with how down everything has been and how much people were positioned for another bad CPI print.
These markets and the way that they move, you can tell that there's this position cleansing in the market.
I think it's important to take yesterday's move in context.
What the market has essentially done is moved a lot more probability weight into the kind of soft landing camp.
I think people are just so itching to see the end of this Fed hiking cycle. I think some of this was just on the back of, oh my goodness, we finally see what's going to happen to slow the Fed.
It's what we've been waiting for, right?
Yesterday's CPI actually gave a lot of people a green light to do something they wanted to do already.
The way I look at it is that in March of 2020, the window of opportunity, in my view, was only open for about 2 weeks. The window of opportunity for doing things at the moment is probably more like 2 years, maybe even 3.
Those are some of our guests reacting to yesterday's CPI-fueled rally. All right, let's get more on this with Gargi Chaudhry, head of America's iShares Investment Strategy over at BlackRock. Gargi, where does the rally have legs? Can you still buy into it?
Sure. Good morning, guys. It's good to be here. So we were just talking about this earlier. Look, I mean, a part of what happened yesterday makes complete sense. The market was starved for some good news on the inflation front, and we got that. We haven't had a 0.2, unrounded 0.2 core print, 0.27 core print since September 2021. So this was obviously very exciting, and the details of the inflation number, if you looked at the diffusion, where the deceleration came from, was absolutely very encouraging if you're a Fed watcher or a policymaker. But at the same time, this is just one print.
One print, as we know, does not make a trend. It's a very good signal. It's necessary, but not sufficient. So I think we have to see at least 2 or 3 more prints that are along these same lines of, sort of 0.2 to 0.3 for us to really believe that the Fed is going to pause and obviously continue to see the market rally. And I don't think we're quite there yet.
Gargi, as you well know, the second half of the marathon is tough. We're gonna go 9 to 5, but then we've got to get 5 to 2. That second part, how hard is it going to be, and what's the Fed going to have to do to get us there?
Yeah, good point. So this is like being on mile 20 of the marathon, right? You're already in some pain. You've suffered through a lot, but you still have 10K to go. And that was me on Sunday. It was 80 degrees and it was horrible. And I think with the inflation data and the Fed, they've seen the inflation come down from 9%, the first move from 9% down to a 7 handle, and perhaps even getting to a 5 handle. That's the so-called easier part. I mean, it's not easy, but that is the part that is already underway. But if the Fed is truly going to be restrictive till they get it from the 5 handle down to a 3 handle, we're not seeing that till much towards the end of next year. So that's still far away. For us to now believe that this is the immediate signal to buy all equities, both hands, I think we're getting a little too ahead of ourselves. But this was a very good first step.
And there is some follow-through now. After the U-Mission, you're looking at NASDAQ 100 up by about 1%. So there is some follow-through. Gargi, I'm wondering, though, even if we still get restrictive rates, if we get there a little bit slower, does that mean that the dollar can have already found some kind of top in the medium term? Same thing for yields.
Yeah, I think so, absolutely. I think there's a slower path. There's also the opening of the possibility that in a couple of months, the Fed is very quickly going to signal a pause, and then a few months after that, maybe we'll get excited about a pivot again. So I think owning yields here, and we've been talking about this for some time, owning high quality yields here in the credit space, in the mortgage space, even in inflation-linked bond space with real rates being where they are, I think that makes a lot of sense in your portfolio. And look, I would also say that when it comes to the equity market, there are pockets where you are supposed to continue to be allocated. We've been talking about energy equities. We've been talking about healthcare equities. We're still sticking to that theme. There will be a time when you're supposed to pivot away to that growthier, the quality growth part of the basket. I don't think that's quite there yet. Market certainly trades like that. I think a lot of that is just short covering and sort of a FOMO. Don't want to miss the rally, but I don't think this is the beginning of that buy quality, buy tech move quite yet. I can certainly see the Fed getting very uncomfortable about the amount of financial easing that has taken place and pushing back on some of this.
Gargi, just to continue the theme though, as you look at the ETFs in front of you in your universe, what right now would you look at as having the best correlation with the turn in the dollar?
Yeah, so obviously the first thing that comes to mind is just looking at some of these incredible local currency EM space. I mean, that's had an incredible run, looking at something like an LEMB, which gives you access to local currency EM bonds. That would be one. I would also say, obviously, dollar and rates are very correlated. So thinking about something like IGSB, which gives you that front-end credit, that's something that you should gravitate towards. I'd also think just the front end of Treasury markets itself. We've seen a tremendous amount of rally, but I think we can certainly see more there. So SHV, SHY, those are all areas of the market that investors should be gravitating towards. Earning about a 5% yield on just AGG, that's incredible. So with the stabilization of the dollar, I think EM, especially local currency EM, looking very attractive. Or, if you are of the camp that this is just the beginning and can continue, certainly more of that to go in the weeks and months ahead.
All right, Gargi, look, really great stuff. Super appreciate it. Gargi Chaudhry of BlackRock. Right now you're looking at a live chat of President Biden speaking of COP27 over in Egypt. Let's listen in to what he's saying.
Leaders, it's an honor. It's an honor to once again participate in this critical summit. And I'd like to thank our host, President Sisi, for bringing us together at this pivotal moment. Thank you, Mr. President. Let me start by acknowledging that this day is a day of commemoration at home in the United States. It's Veterans Day. America's veterans and their families, survivors and caregivers, are the very spine and soul of the United States. And on this special day, on every day, I honor all of those who sacrificed for our nation like my son. I want to thank one proud American veteran, a lifelong public servant, a dear friend, and literally one of the most decorated men to fight, Special Envoy for Climate, John Kerry. John. John, your commitment, your passion, your diplomatic expertise have been absolutely critical to delivering incredible progress on climate issues over the past 2 years. And I thank you, pal. I thank you for being my friend. Here, critical to delivering incredible progress on climate issues over the past 2 years. And I thank you, pal. I thank you for being my friend. Here in Egypt, the Great Pyramids and the ancient artifacts stand as testament to millennia of human ingenuity. We see our mission to avert climate catastrophe and seize a new clean energy economy not only as an imperative for our present and future, but through the eyes of history. According to the World Meteorological Organization, the past 8 years have been the warmest on record. In the United States, we're seeing historic drought and wildfires in the west, devastating hurricanes and storms in the east. Here in Africa, home to many nations considered most vulnerable to climate change, food insecurity. Hunger follows 4 years of intense drought in the Horn of Africa. Meanwhile, the Niger River in West Africa, swollen because of more intense rainfall, is wreaking havoc on fishing and farming communities. In Nigeria, flooding has recently killed 600 people. 1.3 million more are displaced. Seasonal livestock migration routes have been used for hundreds of years, are being altered, increasing the risk of conflict between herders and local farming communities. The climate crisis is about human security, economic security, environmental security, national security, and the very life of the planet. So today, I'd like to share with you how the United States is meeting the climate crisis with urgency and with determination to ensure a cleaner, safer, and healthier planet for all of us. From my first days in office, my administration has led with a bold agenda to address the climate crisis and increase energy security at home and around the world. We immediately rejoined the Paris Agreement. We convened major climate summits and reestablished. I apologize we ever pulled out of the agreement. We established major economies forum to spur countries around the world to raise their climate ambitions. Last year at COP26 in Glasgow, the United States helped deliver critical commitments that will get 2/3 of the world's GDP on track to limit warming to 1.5 degrees Celsius. Over the past 2 years, the United States has delivered unprecedented progress at home. Through a generational investment in upgrading our nation's infrastructure, we're making our power grid better able to transmit clean energy, expanding public transit and rail, building nationwide network of electric vehicle charging stations, over 50,000. And this summer, the United States Congress passed and I signed into law my proposal for the biggest, most important climate bill in the history of our country, the Inflation Reduction Act. It includes less than I asked for, but a significant amount, $368 billion to support clean electricity, everything from onshore, offshore wind to distributed solar, zero emissions vehicles, and sustainable aviation fuels, more efficient electrified buildings, cleaner industrial processes and manufacturing, climate-smart agriculture and forestry, and more. Look, our Department of Energy estimates that the new law will reduce emissions in the United States by about 1 billion tons in 2030, while unleashing a new era of clean energy-powered economic growth. Our investments in technology, from electric batteries to hydrogen, are going to spark a cycle of innovation that will reduce the cost and improve the performance of clean energy technology that will be available to nations worldwide, not just the United States. We're going to help. The International Energy Agency recently concluded that our significant climate investment will, quote, help turbocharge turbocharge the emerging global clean energy economy. I was reading their quote, sorry. It's going to shift the paradigm for the United States and the entire world. We also ratified the Kigali Amendment to rally the world in phasing down the production and consumption of HFCs, greenhouse gases, that are thousands of times more damaging than carbon dioxide. And just yesterday, the United States became the first government to require that our major federal suppliers disclose their emissions and climate risks and set targets for themselves that are aligned with the Paris Agreement. As the world's largest customer, with more than $650 billion in spending last year, the United States government is putting our money where our mouth is to strengthen accountability for climate risk and resilience. These critical steps are already locking in vital investments in our infrastructure, delivering lower costs for clean energy, spurring good-paying union jobs for American workers, and advancing environmental justice in our communities. Folks, we're proving that good climate policy is good economic policy. It's a strong foundation for durable, resilient, inclusive economic growth. It's driving progress in the private sector. It's driving progress around the world. And the sum total of the actions my administration is taking puts the United States on track to achieve our Paris Agreement goal of reducing emissions 50 to 52% below 2005 levels by 2030. Let me just take a moment to emphasize how meaningful it is that I can say that. I introduced the first piece of climate legislation in the United States Senate way back in 1986, 36 years ago. My commitment to this issue has been unwavering. Today, finally, thanks to the actions we've taken, I can stand here as President of the United States of America and say with confidence, the United States of America will meet our emissions targets by 2030. We're racing forward to do our part to avert the climate hell that the UN Secretary General so passionately warned about earlier this week. We're not ignoring harbingers that are already here. It's true, so many disasters. Climate crisis is hitting hardest those countries and communities that have the fewest resources to respond and to recover. And that's why last year I committed to work with our Congress to quadruple U.S. support to climate finance and provide $11 billion annually by 2024, including $3 billion for adaptation. That's why the Fund Emergency Plan for Adaptation and Resilience, PREPARE we call it, to help more than 500 million people in developing countries respond to climate change. We're already requested more than $2 billion for the PREPARE this year. I'm going to fight to see that this and our other climate objectives are fully funded. Today, as a down payment, we're announcing more than $150 million in initiatives that specifically support PREPARE's adaptation efforts. throughout Africa, including Adaptation in Africa, effort that Egypt and the United States launched together in June. This includes support for expanding early warning systems to help cover Africa, broadening access to climate finance, providing disaster risk protection, strengthening food security, mobilizing the private sector, and supporting new training center in Egypt to accelerate adaptation across the efforts all across the continent.
You've been listening to President Biden at COP27 in Egypt, committing to more funding and talking about private-public partnerships as well as funding for developing nations. He also reiterates the U.S.'s pledge to meet its emission targets by 2030, saying that he agrees that the health of the planet, the life of the planet is at stake. We want to avoid a climate hell. I think, Guy, that ending on the financing is an interesting part because how we pay for this still hasn't truly been resolved, and that is going to be an enormous issue for developed and developing nations.
Yeah, we've seen some progress. Clearly, there are significant areas that we continue to need much progress on in that area. It is incredibly delicate what is happening here. The conversation incredibly difficult. I thought his focus on the IRA was interesting as well, the Inflation Reduction Act, talking about how that policy is going to impact the position of the United States in this debate. It's going to be interesting if we are going to go into a gridlocked environment in D.C., kind of what happens to the IRA. What I've read thus far seems to indicate very little. Actually, there's quite a lot of consensus around that policy on both sides of the aisle.
Yes, but it's debatable whether or not individual countries in Europe like the IRA, saying basically it's like subsidies to certain industries here in the U.S. That debate obviously continuing about who's going to wind up paying for it. If you want to listen to the rest of President Biden's speech, you can go to LiveGo on your terminal. And remember, he is headed from here to Indonesia for the G20 and also meeting with President Xi on Monday. Let's go back to the markets here. We're about an hour into the U.S. trading session. It's mixed, but it does feel like tech is trying to make a bit of a run for it. Bloomberg's Abigail Dulabille is tracking the moves. Abigail?
Yeah, well, Alex, in terms of the week, it's clearly a risk-on week. So much happening this week. Another week that feels like a year between the FTX, now bankruptcy, and then CPI. But CPI clearly taking it with the NASDAQ 100 heading to its best week going back to June, up 7.6%. Of course, yesterday on that cooler than expected CPI, the idea that maybe peak inflation is here really took yields down. However, it is interesting because we, of course, have this contagion fear around the crypto space and FTX going bankrupt in terms of different exchanges, what it could mean for institutional money relative to Sam Bankman-Fried. It means a loss of about $16 billion, an FTX stake of about $8 billion, Alameda Research, the proprietary trading arm, $7.4 billion, and then a Robinhood stake of $500 million. So not a great week there, and I think some more news was just coming out about he may be providing some sort of an account, play-by-play account of what's going on. I know that Sonali, Alex, and Guy will be talking about that in a minute. Relative to the big gains on CPI, though, largely tech, because, of course, tech benefits when yields are down. If we take a look at this, is actually having to do with the China reopening. We do, of course, have China, Guy, as you know, loosening its zero COVID policy. Lots of hopes around that. We've had speculation about that for weeks, but now that there seems to be some sort of reality to it, the Hang Seng up 7.7%, the Golden Dragon China index here in the U.S. up another big day, up more than 10% over the last 2 days. And then you can see that crude oil and aluminum also getting a bid. China, of course, is the world's largest user of natural resources, helping out that commodity complex as well, Guy.
Just easing up on some of the quarantine rules as you go into the country and if you are exposed to somebody that has had COVID. But COVID numbers are rising in China. It's going to be interesting to see whether or not you can extrapolate this into an easing or broad easing of what's happening with the COVID rules. Abigail, thank you very much indeed. Tech clearly paying attention to what is happening with the rate story. Bond markets clearly closed for today, though, in the United States in observance of Veterans Day. Let's talk about some of the corporate numbers.